Hey folks, by popular demand, we are diving down into two of my favorite Canadian monthly paying dividend stocks, the first of which being a company I bought 7 years ago, one of the first stocks I ever purchased in my investing career, called Northland Power, a natural energy utility company that I currently own 508 shares of, with a yield on cost, that juicy dividend sitting well over 5% paid monthly, with the second company we're diving into called Riocan, a real estate investment trust focused in my backyard of Toronto, at which I own 1,070 shares. We were largely picking up in the dip of the March 2020 crash, and my yield on cost, again, well over 5%. We're going to be going over what I liked about the earnings, what I didn't like, and what I kind of look forward to in the future. So consider hitting that like button, folks, for this in-depth clarity into my transparency here, folks. So let's kick it off with Northland Power. First and foremost, trading down a whopping 15% year to date. Not looking that hot considering the earnings weren't even good, yet the company is trading up 1.17% the day after they posted yesterday. So, I mean, clearly we're kind of hitting a floor, and I think we're hopefully going to start seeing a little bit of a turnaround, but that's only if we can start seeing better quarters moving forward, because this earnings was not fabulous. So let's just take a quick preview here, guys, because we can see for the 9-month end, they went from 1.5 billion to 1.4 billion in net sales. Not that fabulous. Gross profit is down, operating income is down, but where my big red flags appear is when we take a look at the total dividends declared, because I'm starting to get a little edgy about their payout ratio, because their adjusted free cash flow, which is one of the most important metrics, because this is the cash flow they have after all those operating expenses and everything to buy new acquisitions or pay those dividends, was sitting at 204 million. Now, they declared a dividend for the 9-month end of 196 million. That is not very far off from 204 million. So I'm really hoping this is the basement bottom they're going to hit, because we cannot go below the cost of the dividend payout, or we're getting into scary territory, right? Compared to this time last year, they paid out, or they had a adjusted free cash flow of 338 million against the declared dividend of 184 million. So this time last year, guys, they had a lot more room to pay that dividend. But some things I did like about the earnings is coming down to the total assets, because currently they sit at 12.8 billion in total assets against last year, where they had 11.4 billion, which means they increased their total assets by something like 1.5 billion dollars, against the total liability that went from 9.39 billion to 9.9 billion this year is only increased by about 400 or 500 million. So they've been able to add almost an extra billion of total assets to the bottom line without increasing their total liabilities that much. So that's pretty good. But why are they trading down so much? I mean, if we take a look, sales decreased 8%, adjusted EBITDA is down 17%. I mean, free cash flow decreased 83%, like just things I do not want to hear. And they're claiming this is coming from abnormally low wind conditions in the North Sea, persisted in the third quarter, resulting in reduced financial contribution from our 3 large offshore wind facilities, which, by the way, are some of the largest on the planet. However, consistent with last quarter, we remain on track to meet our low end of our 2021 financial guidance, largely due to the performance of our onshore wind portfolio, as well as the increasing diversification within our operating portfolio, thanks to our Colombian utility EBSA and the recently acquired solar and wind portfolio in Spain, both of which are performing well. So that's pretty good, I guess. It's kind of like, oh my God, how in the middle of the ocean there off the North Sea in Germany is there no wind coming out? How is there normally low wind, yet somehow on land wind projects are getting more wind and generating great power? I don't know. So hopefully this is an anomaly that will change in the coming quarters and the wind will pick up in the North Sea. But strategically, we continue to advance to position ourselves for strong growth this decade with a portfolio of identified projects that will add 4 to 5 gigawatts of renewable energy capacity coming from Spain, a few other projects, and the Japanese offshore wind projects. So there is some growth to look forward to, and I'm hoping, like I said, that this is the basement bottom prices we're going to see for those dividend from their free cash flow comparison, because God, guys, if that dips in another direction, I'm seriously going to have to consider maybe pulling some of the risk off the table. But I think we're okay, and I really don't care as much about capital growth from these stocks as I do about the sustainability of the dividend, because it's primarily why I own them, right? So let's talk about Riocan, my favorite real estate investment trust of all time. For the 1 day is actually trading down after earnings, even though I thought their earnings were pretty good, and not really trading down, just flat for the day. But year to date, the company is trading up, if we can get that to load, a whopping 40%. We are not back to all-time highs yet, but let's discuss real quickly, guys, how I feel about these earnings, with the first first and foremost thing being rent collection. Coming out of the pandemic, my biggest concern for this company was not getting back to about a 96 to 98% rental collection. And they actually excelled that this quarter at 98.1% total collected. And the reason this matters so much to me is obviously you don't want empty property sitting there costing you money. And when you compare it to some of the best REITs currently on the market, like Stag Industrial, Granite Real Estate, that are collecting 99% of their rents, I want to be in that upper percentile to know that the company is actually doing a good job with managing the properties and getting them filled with tenants or selling them, right? So Riocan is doing a great job on that end of it. Taking a look at Riocan Living, high quality rental residences, they've actually been steady rent collections of 99%. So from the residential side of the portfolio, which honestly is what I'm paying most attention to, because even though this is primarily encored by grocery stores, kind of outdoor malls and things of that nature, they're trying to pivot, and they have like something like 40 million square feet of development, primarily in residential here. And we're seeing that that's where they're collecting a huge percentage of rent. And take a look at some of the growth we get to look forward to in this company. When we take a look at condo and townhouse development here, guys, take a look at the status on these. I mean, sold out, 99% pre-sold, 95% pre-sold. And some of these don't come online until 2024, 2025 timeframe. I mean, this is great. I mean, take a look at these ones here. We got sold out, 78% pre-sold, 88% pre-sold, 96% pre-sold. And these are all after 2025, 4 years out from now. So this makes me feel real good about the future of the company. I mean, they've got a lot still coming online, lots to look forward to. They did about 40 cents in net operating income, or I think funds from operation. And currently the payout from their funds from operations is 70%. I listened to the earnings call. They're retaining about $150 million in cash flow from the dividend cut. And it looks like they're going to continue to use that to basically strengthen the balance sheet. They've been paying down debt, things of that nature. So I kind of like the new CEO because he seems more growth centric than dividend centric. And I know a lot of people want to see the dividend come back, but honestly, we've got lots of safety now in the dividend. I'm well over 5% with it. So I feel like I'm in a really good, secure position with this company currently today. And I feel pretty glad about that. But let's just take a look here real quick. Total assets sit at 15.2 billion, a little tiny increase from this time last year, guys. Total liabilities sit at 7.3 billion from 7.5 billion. So we can actually see them paying down their debt, really good from an asset to liability ratio. Now, things a little concerning. Obviously, the revenue is a little choppy here from 814 million to 800 million roughly for the 9-month, and a slight decrease, nothing to really get too concerned about, but it's nice to finally see some stability coming within this company. So Riocan, I'm going to put at the top of the list over Northland Power for security in the dividend, but these were kind of the earnings that came out here, guys, for my two favorite monthly Canadian paying dividend stocks. I think things are going to be okay for now. I'm hoping the North Sea, we can see some more power generation from Northland Power, and we can get off this base of almost touching the dividend payout. But for Riocan, we're all sleeping real easy at night. The earnings call was great. I want to pass the question off to you. What are your favorite Canadian dividend stocks? I want to know, what were the earnings like? I've been paying attention to a lot of the banks, a lot of other stuff going on right now, guys, but at least it's been a non-choppy earnings cycle for us so far. I mean, it's not been that bad. So stay cool, stay awesome, and I look forward to catching you tomorrow.